So we have today with us CA Yogesh Thar, and he will be dealing with issues. Now, issues may be resolved, unresolved. So CA Yogesh Thar is attempting to resolve some of our unresolved issues, or to speak about them and share his thoughts. So, to give a formal introduction, I call upon our past convener, CA Haridas Bhatt.
Good morning, everybody. I know everybody is busy finalizing the tax reports this week. We thought this would be the apt Sunday to understand and to resolve the issues. That's why Mr. Yogesh Thar is here to resolve our issues. Mr. Yogesh Thar doesn't need an introduction because he's a regular speaker in this forum, especially JP Nagar. We have kept a method of calling him at least once a year. Sometimes it is more than once a year. At least once a year, Yogesh Bhai comes here and gives the lecture. So we all know him that he's partner in Bansi Mehta Company, and he's expert in litigation. You can see him regularly in the IT and other places. He's qualified in 1984, started as a sole proprietor, then partnership, then ended up with Bansi Mehta, where he's shining today. And he has authored several books which is published by Taxman, Chamber of Tax Consultants, BCAS, etc. And he was also visiting faculty in Narasimhan Institute of Management from 92 to 97. And he served as a joint editor in Bombay, this BCAS publication, the Referencer Cum Diary. And you all know that he has given presentation in so many workshops, lectures, etc., etc. So we have got actually, Yogesh Bhai, we got confirmation for 200 people almost, but I can't see the crowd. Sorry for that. Anyway, before I hand over the mic to him, I request our regional council member Pinky Kedia to present a memento to Yogesh Thar. The issues are taken by Yogesh Bhai as per what he feels important. And after that, if you got any further issues, we'll be open for the questions. Over to you, Yogesh Bhai.
Yeah. Good morning, everyone. I think the a better model could have been that leave the floor open for question. Everyone can prepare the questions, and then you could have gone. Probably, in retrospect, I think that could have been a better option because we don't have too many people, and then with a class of people, you would have got class of questions also. But anyway. What we did told me was that I bring out issues relating to individuals, private companies, and something related to non-residents. So I've tried to do that. And the first few minutes we will concentrate on, we'll just have a look at some of the recent provisions in the finance. Good question. So some of the recent provisions in the Finance Act 24 dealing with essentially dealing with individuals, and something of importance to everyone, not necessarily individuals, like house property versus business, a little bit of a controversy there. And then I have picked up issues which are not very common, but nonetheless we need to have a proper knowledge as and when we are faced with the situations to deal with it. So private discretionary trust, there's certain aspects of that. We make certain common mistakes. And there's one very common mistake that I find across every, private discretionary trust. I would like to highlight that. And as individuals, employees, ESOPs is one of the source of their revenues. And there's a very recent controversy on ESOPs where you have two high courts on the very same facts taking contradictory views. And there are certain issues on ex gratia compensation, on termination of employment, and other issues. And then going to company. So I also would like to spend some time on what happens after the individual dies. And you have section 159, you have section 168, and what is the range, or what is the domain of these two provisions? A very broad overview. I've got 3, 4, 5 slides on that, so we can quickly have a broad overview. No controversies over there, but something which we don't come across on a day-to-day basis, but when we come, we fumble, and therefore we don't know how to deal with the issues. Then on private companies fronts, two or three interesting issues on section 79. Then we have a lot of issues. We have a lot of concerns on non-compliant conversion of companies into LLPs, where we cross the limits of 60 lakhs and 5 crore assets. And then what happens in that situation? Sometimes we are faced with a situation where we have to do it. So what are the consequences of that? And just one or two issues on some tax issues on something which can affect all of us at CA firms, and a couple of small issues on NRI. So this is the broad overview of what I'll be dealing in the next 1 hour, 15 minutes, 1 hour, 30 minutes. On the tax rate front, just a bit of a warm-up before we start on the subjects in detail. You have this new tax regime post-Finance Act 24, and we have pre-Finance Act 24. And we find that with the total income, of course, the threshold has been increased from 250,000 to 3 lakhs. But then the tax savings that you find, thank you. At the level of 10 lakhs rupees to 50 lakhs rupees, tax savings is 10,400. 1 crore rupees tax savings is 11,440, and 5 crore and above the tax savings is 13,000 rupees. This is the tax savings that you find based on the newly amended section 115 BAC. Then in the area of individuals, section 16 got amended by Finance Act 24, where standard deduction has been modified. And the previous provision was that you have standard deduction to the extent of rupees 50,000, and it's available to every SSE. But now we are told that a person who gets into the new regime will get 25,000 more, so standard deduction increased to 75,000, but only for those who are into the new regime, 115 BAC. And the rationale given in the explanatory memorandum was that with the aim of incentivizing and encouraging the taxpayers to shift to the new regime, this amendment has been made. 57, family pension. So that if a relative of a deceased employee earns family pension from the employer, then that is taxable in the hands of the relative as income from other sources, because there is no employer-employee relationship. And then there is a standard deduction allowed to them under 57 itself against that income which is charged under 56. You have a standard deduction of 57, and that standard deduction today is 1/3 or 15,000, whichever is less. Now that limit has been, that 15,000 has been increased to 25,000, and we are told that the 1/3 remains 1/3. So 1/3 of 25,000, which is lower, but that will only be for those who have opted for the new regime, who have gone for the new regime. So once again, the rationale in the explanatory memorandum to encourage people to get into the new regime of taxation. Then an amendment in respect of employers' contribution to NPS, National Pension Scheme. So here, let's have an overview of what provisions are there in this, in the Act, and what have been amended and what have not been amended. And so we should, because I would like to highlight what has not been amended in this whole thing, and what could be the consequences. That despite some relaxation given, there could be situations where you can be worse off because of this amendment. So you have section 17 to 8 in the Act, which says that the employer's contribution to NPS will be treated as your income under the head salaries. So it is in employer's contribution treated as salary, 17 to 8. Then after the GTI level, 80CCD2 says that we will give a reduction of that employer's contribution, but that deduction will be to the extent of 10% of your salary for non-government employees and 14% of salary for government employees. So it's first included, employer's contribution included in salary, and 80CCD gives you a deduction to the extent of 10%. That's one provision. Then you have 17 to 7, which provides that if the aggregate of employer's contribution to recognized provident fund, superannuation fund, and NPS exceeds 7.5 lakh rupees, then such excess would be taxable. Now, this provision has not been amended. This remains the same, and we'll quickly have a look at what is the consequence of that. Then you have 80CCD1, which says that the employee's own contribution to NPS up to 10% of salary would also be allowed as a reduction to you. Then under the new regime, 115 BAC2, it provides that the persons covered under the new regime shall not be entitled to deduction under 80CCD1. That means employee's contribution he would not be entitled to, but he would be entitled to claim deduction under 80CCD2, that is the employer's contribution. And then we have, from the company's point of view, you have 3614A, which provides for deduction of an employer's contribution to NPS account of an employee to 10% of salary. This is the provision prior to the amendment. Now, two amendments are made. One, 80CCD2, which is in relation to the employer's contribution to NPS. The 10% limit for non-government employees has been jacked up to 14% of the salary for non-government employees, but for those who opt for new regime only. So therefore, there also now therefore we'll have two limits: 10% for those who have not opted for the new regime, and 14% for those who are opting for the new regime. And correspondingly, the limit for deduction of the employers under 3616A for the deduction has also been increased to 10 from 10 to 14%. But for 3614A, there is no such requirement that the employee should be in the new regime. That is independent of the employees being in the new regime or the old regime. The employer will get a deduction up to the extent of 14% of the salary. And here again, of course, there's no rationale mentioned in the explanatory memorandum, but it appears that in order to encourage people to go in for the new regime, this has been given. Now, the point for consideration here is that the limit of 7,50,000 for all the three has not been amended. So therefore, as a result of this amendment, even after the increase of 14%, 10 to 14% of the employer's contribution, if the aggregate of RPF, the recognized provident fund, superannuation fund, and the NPS exceeds 7.5 lakh rupees, it will still be treated as your income, so that 7.5 has not been amended. So that is one thing. And secondly, as a result of that, what happens is that if that limit crosses 7.5 lakh rupees, because of 17.1A, that employer's contribution will first be treated as your income, right? And having treated as your income, you will not be eligible. If the gross total income is nil, you will not be eligible to ADCCD to deduction. And to that extent, therefore, there could be an element of double taxation in the hands of the employee. So this could be an adverse implication of this amendment, but then that is what it is. Then comes the favorite topic, which is not merely to individuals, it can be to individual firms, even companies where properties are given on rent. And age-old maramari as to whether the rental income should be treated as business income or income from house property, and that continues. And we have an amendment, a very strange amendment, I feel, which has been introduced in section 28. It's amendment in the business chapter, where by way of adding an explanation, we are told that the income arising from letting out of a residential house or a part thereof shall be taxable under the head house property and business. So it's come by way of an explanation. Now we know that section 22 says that income arising from letting out of a house property other than which is occupied for the purpose of business will be taxable under the head house property. So if you are occupying a premises for business, then the income will not be taxed in the house property. Otherwise, income is taxed in property. Now there have been rulings on both the sides. I mean, way back from I think 1950s and 60s, that which is the correct head under which the income should be taxed, whether it should be house property or business. But now, so far as the residential houses are concerned, amendment from 1425 says that the income from letting out of residential houses will not be taxed on the business, but it will be taxed on the head house. And the rationale is explained in the explanatory memorandum says that, look, the amendment is intended to undo the practice of the taxpayers to substantially reduce the tax liability by reporting the rental income generated from letting out of house properties under the head business instead of house property. So they feel that we are claiming a lot of expenses and therefore we are reducing the income. But it's the other way around also. If you always treat it as house property, then probably many a times 30% deduction, standard deduction is also better than claiming it as business. So you can have both types of situation, but nonetheless, this is the thinking of the legislature. Now, a few points for consideration. Added as an explanation to section 28, and they say that it is hereby clarified. Now, does it therefore mean that this is only a clarificatory amendment and therefore it can apply retrospectively? Because they're saying it's hereby clarified. The answer to that is, to my mind, no, it's not clarified. They have worded that it is hereby clarified, but it is not applicable retrospectively. The amendment is applicable from assessment year 25-26 as very specifically stated in the explanatory memorandum itself, and therefore it cannot be read as retrospective, and we have many authorities to that effect in context of other provisions. Then, as I said, the amendment applies only to residential houses or part of the houses, and therefore this amendment by itself will not apply to commercial premises. This is one more thing to be noted. That per se does not apply to. But the point really is, what is the impact of this amendment? Now, take an example of a person running a hotel or a person running a service apartment, right? It's his full-fledged business to run a hotel, this hotel. Suppose it was there a sole proprietor individual or a partnership firm or a company whosoever owning the hotel. And the hotel lets out rooms. Undoubtedly, it's not for commercial purpose, it is for residential purposes, for living over there. It can be for 1 day, 1 hour, 1 month, 1 year, whatever it is, but the rooms are let out. Similarly, you have service apartment. People live in service apartments when they go for work in different cities, etc. So income from letting out of hotel rooms or letting out of service apartment. Does this amendment mean that letting out income will always be treated as income from house property and never as business? To my mind, that would be a bizarre sort of a implication of this amendment, because a person running a full-fledged business, you can't expect that income to be taxed. Get out from the from the chapter of business and get into house property income. To my mind, that's not the consequence. So what's the difference here? In an example of a hotel or a service apartment, you have three elements. One is the element of letting. Second is an element of inseparable letting. So you have all these equipments and ACs and all the facilities and jacuzzis and swimming pools and whatnot as an integral part of this letting. But for these facilities, I would not come and stay in a hotel. And therefore, it is not merely the letting of four walls, but it is also letting of furniture, fixtures, equipment, and facilities. Okay, so that is one added angle. And the third added angle is service. So provision of various services by hotel and by service apartment type of situations. Similar situations would be there even in business centers, but because we are concentrating only on residential, I'm not talking about business center, but effectively it is the same. So there are three elements in this type of an activity: bare letting, letting of four walls, plus inseparable letting of furniture, fittings, equipments, and third is rendering of services or housekeeping services or this, that, etc. So when all these three elements are there, then certainly this cannot be treated as income from house property. This has to be treated as income from business. It's systematic business activity, systematic organized activity, undertaken by an entity. Then that, if you all agree that a hotel income cannot be taxed as income from house property, then let's go to a step 2 where you reduce from the 3, you remove the third element, that is a service element, that you don't have plumbers, you don't have electricians, you don't have people running around on calls, etc. You don't have those type of services. Okay, but you do have four walls plus the infrastructure, the furniture, fittings, equipments, etc. And therefore, that is an inseparable letting. So a person who is, say for example, an individual employee working somewhere is selecting a house which is fully furnished because he's absolutely busy. He does not have time for anything. Therefore, he needs all the gadgets. At a press of a button, his things should be done according to him. And if those facilities are not there, he would not go and select that house. He will better go and select some other house. So once again, a inseparable letting. Okay, that in absence of these facilities, equipments, etc., I shall not go and get this rented. I will better go and get myself accommodated in a place which is fully furnished. Now, that is what is inseparable letting. The question is whether this amendment affects that. To my mind, again, no, because inseparable letting, you have section 56. You have specific clauses in section 56 to say that when there is an inseparable letting of plant, machinery, furniture, fixtures along with building, then the income would be taxed under the head income from other sources if it is not taxed as business, right? So that section itself presupposes that such inseparable letting can be somebody's business. But if it is not somebody's business, so not a regular activity, etc., then it can probably fit under income from other sources, and therefore that makes it impossible to take it under the head house property because you have specific section 56 one which has two clauses specifically devoted to this purpose. Mind well, those clauses are as it is there, not amended. What they have done is only explanation added to section 28. And therefore, to my mind, this explanation cannot override that provision. That provision presupposes that an inseparable letting is either business or income from other sources. So, And what is inseparable letting Supreme Court in Sultan Brothers has explained, and as I mentioned in brief, that if I were not to accept a particular room without these facilities, okay, then it's inseparable. I will not go here. I'll better go to some other place where I have everything well furnished and I have all the facilities that I want. At a press of the button, my work should be done. So therefore, friends, first element for hotel type of cases and this premises with fully furnished and fully equipped houses. These two, to my mind, get out of the provisions of this explanation, the newly inserted explanation anyway, right? And therefore, what is left? Therefore, what is left is really their letting of property with the regular facilities of watchman, sweeper, etc., which in a building anyway the person provides that, he provides a lift, he provides water, etc., something which is normally given. That we are not talking about those type of facilities. In fact, in that context also we had an old decision of the Supreme Court in Karnani properties, but then after that, there also they said it would be taxed as business income. But nonetheless, after that, a lot of water has flown, and those type of cases will only remain, which anyway today are taxed under the head income from house property and not as business. And most of the maramari are those type of cases where people want to get it taxed under the head business, etc. So apparently, therefore, what is the impact of this amendment? The impact of this amendment doesn't seem to be much, but there is one angle, and that is the angle where there is a builder who has stock in trade, okay, which is not sold. So he has constructed residential houses, he has got the OC, and yet he has not been able to sell it. Now, in that context, you have section 23(5) of the statute, which says that, look, up to a period of 2 years, also beyond a period of 2 years, if that property still remains vacant. So there is a stock in trade which remains vacant beyond a period of 2 years, then it will be deemed to be let out. The income will be chargeable to tax under the income from house property. You have section 23(5) to that effect. A view was always taken that 23(5) is not a charging section. Okay, it only says that the stock held up to 2 years from the date of CC and not let out, the annual value will be nil. It doesn't actually say the reverse. It says that which is held up to 2 years from the date of CC and not let out, the annuals will be nil, and therefore it's not a charging section. It only gives an exemption that we will not tax you for the period of 2 years. However, it has been interpreted as charging section, and there are assessments which have happened, and the matters are in litigation anyway. Now, if you look at the law on this subject, section 22, as we saw earlier, says that income arising from letting out of the property other than which is occupied for the purpose of business is to be treated as income from house property. Right? Now, the question is stock in trade a property occupied for the purpose of business or not? Now, the Gujarat High Court in Neha Builders and Orissa High Court in MP Bazaar, the first one and the last, had taken a view that rental income in respect of stock in trade is always to be treated as business income. It will fall outside the chapter of house property, because the very threshold says that a property occupied for the purpose of business falls outside the ambit of house property. However, you have Delhi High Court in Ansal. First Ansal came in, I think, 2013, and the second one in 2018, where they have taken a view that no, even if it is a stock in trade, then and it is let out, then the income is chargeable under house property and not business. And there the Honorable High Court has made a distinction between use for the purpose of business versus occupied for the purpose of business. So they say that a property, when it is let out, or maybe when it is vacant, not let out, it is not occupied for the purpose of business. A stock in trade may be used for the purpose of business, but it is not occupied. And that distinction they made, and they held that this income would be taxed as income from house property. Interestingly, the Delhi High Court at both the instances missed out looking at an earlier Delhi High Court, a full bench decision in Modi's case, 210 IPR, where they had actually explained what you mean by occupied for the purpose of business. And if one looks at the interpretation of occupied, if that Modi's decision were considered, would have been considered by Ansal's decision, subsequently, probably the conclusion could have been different. So it is still today a debatable issue. In any case, different courts have taken a different view on the subject. So now the question is, does this amendment affect these type of cases where now they amended the business chapter and they've said that, look, all income from letting out of residential houses will be treated as business, will be treated as house property and not business. So probably it looks like that something which would have otherwise fallen under the head business because of these Neha builders and other decisions. Now, and if it's a case of bare letting, it's not inseparable letting, there are no services, etc. Then in such a case, probably it will fall outside the scope of business. And this controversy now, the department gets more teeth to say that now, look, there is an explanation over there which clarifies that such income will be taxed not as business but as house property. So something which would have been otherwise taxed as business, now the law clarifies that you move it out from business and take it over there. In such a situation, it will apply. It will not apply in all other situations because it's not just the letting out of the property, but it is inseparable letting, or there are services also which are involved. That takes us to the yet another amendment dealing with buyback of shares. I'm dealing with this because you and I, as shareholders who offer shares as individuals for buyback, this provision affects us. The law till today was that the buyback tax was paid by the companies under section 115 QA, and therefore, as shareholders, we were not concerned about it. Now that 115 QA is gone. So because there was 115 QA under which the company would be paying, company used to pay the buyback tax, you had 3 or 4 backup provisions. You had a provision in section 222 which says that buyback will not be deemed to be dividend. Okay, because buyback could be regarded as dividend. There were some decisions also in the context of international buyback, etc., that it is a dividend in the rise of buyback, and therefore it should be treated as dividend. So there was a provision in 222(4) which said that buyback will not be dividend. Then you have section 1034 to say that because company pays tax, the individual will not pay tax on buybacks, and therefore there will be no capital gains chargeable under the head buyback. You also had section 46A, which was a specific provision made in order to tax capital gains on buyback of shares. That provision was there, is there, and shall remain there. But then, till Finance Act 24, that was more or less a dormant provision because of section 1034, which said that the shareholder will not be chargeable to tax on any gains on buyback. And therefore, 46A was a dormant provision. It was used only in some cases where buyback tax 115 QA was not applicable, like foreign companies. It was relevant because foreign companies would not pay would not pay buyback tax in 115 QA. So therefore, if I were to receive proceeds of buyback of shares of a foreign company, then 46A was applying to me at that point of time. So these were the provisions. And now the law has been amended that company will not pay tax, and therefore 115 QA goes. Because 115 QA goes and the shareholder will pay tax, they've introduced dividend. So 222F has been introduced. And because that has been introduced, the exemption in 222(4) has gone away. That now it will be deemed to be dividend. And at the same time, 46A once again comes to life. Now, so what is the law? That the entire procedure, the law they're saying, 222F is saying any payment by a company on purchase of its own shares from a shareholder in accordance with provision 68 of the Companies Act will be chargeable to tax as dividend. So any payment, so it's the entire payment will be chargeable to tax as dividend. And therefore, so what happens is that if it was a mere capital gain, then it's only a difference between what a person gets minus his cost, he would be chargeable to tax. In the case of buyback of shares, the difference between what the company pays and what was the issue price, the company would have paid a buyback tax. Now here on the entire proceeds, the person is going to pay the dividend distribution tax. And therefore they have said that now, so therefore to the extent of cost, there is a double taxation, because to that extent of cost which a shareholder has actually incurred, if those shares are bought back, then he's paying tax also on his cost, and therefore said that, okay, fine, so far as cost is concerned, we will give you a deduction under section 46A. So sale proceeds will be deemed to be nil, and cost will be regarded as a deduction, and therefore what happens is a skewed position, that there will be income under the head dividend, which will be charged to tax at the full rate of tax, and there will be loss under the head capital gains, and that loss will either be set off or will be carried forward as per the law. So that is the situation under the new law. Then they have also amended section 57(1), because now that this is deemed to be dividend, it will be taxed as dividend. Dividend is taxable as income from other sources under 56, and 56 has this provision of 57, where they say that to some extent, in fact, against dividend, there is no deduction anyway allowable even today, except for some interest on borrowings to the extent of 20%. That's the only deduction that you get against dividend income even today. Now they have introduced that when a buyback income is treated as dividend, the 222F is invoked, then the shareholder will not get any deduction whatsoever. So he does not get any deduction. And 115 QA obviously has gone, and then 194 has been amended, that TDS will be applicable on the entire proceeds, because the entire proceeds is deemed to be dividend. Once it is deemed to be dividend, the company which is paying that proceeds will do a TDS under 194. So these are the amendments which are affected for buyback of shares, which will happen after 1st of October 2024. Quickly, some points for consideration. Buyback proceeds to be regarded as deemed dividend, whether or not there are any accumulated profits. So unlike all other dividend provisions, where the dividend is treated as, or where the payment is treated as dividend only to the extent of accumulated profits or what is attributable to accumulated profits, in buyback you don't have that language. Okay, so whether or not there are accumulated profits, for all practical purposes, you may not have a buyback where there is no accumulated profits. Although theoretically, it is possible to do a buyback out of the proceeds of the new issues of shares of this, but by and large, for all practical purposes, you may not face that situation. But nonetheless, there's a difference over here. Cost of acquisition was not allowed under 115 QA, only issue price was allowed. Now cost of acquisition will be allowed as a capital loss, though there could be a timing difference. And as I said, there could be a rate difference also, because cost of acquisition, we will claim a loss under the head capital gains, which will be either 12.5% or whatever short-term gains, and whereas dividend will be taxed at your full rate applicable to individual slab rate. The whole proceeds will be taxed the rates applicable to the shareholder. Section 68 of the Companies Act applies to shares and other specified securities, but 22F will apply only to shares. So where they have said that, they have said here that any payment by a company on purchase of its own shares in accordance with section 68. So 68 deals with shares and specified securities, whereas this section only applies to shares. Interestingly, specified securities as defined in 68 of the Companies Act also includes employee stock options and things like that. But then fortunately here, that is not covered. What is covered is only shares and not other securities. If buyback is not in accordance with 68, then 222F will not be applicable. But buyback, but then today, see, earlier we used to have buyback under the court-approved schemes under the 1956 Act, and therefore we were able to pull it out of 46A in those days. We would bring it within 46A, but we would pull it out from a 222 deemed dividend, because then there would be a reduction of capital. So, but then today, under the Companies Act of 2014, even if there's a buyback under a court-approved, NCLT-approved scheme, it has to be in accordance with Section 68. So there are hardly any instances where there is a buyback which is not in accordance with 68. What is the implication of redemption of preference share under Section 55? Yes, redemption is under Section 55 and therefore it is not under 68, and therefore in those cases, it will not be regarded as buyback for the purpose of income tax. There is no deemed dividend over there. And in any case, preference shares are generally preference shares are non-participating, and therefore your definition of dividend itself excludes that from the purview of deemed dividend at the time of reduction. So redemption of preference shares not covered by this amendment, and redemption of preference shares is a transfer as held by the Supreme Court in NRI CA 224 ITR, and therefore that will give rise to capital gains taxation. How is reduction under Section 66 of the Companies Act different from buyback under Section 68? Yes, buyback under Section 68 and 66 are two different things. Once again, reduction will give rise to deemed dividend under Section 222D. Buyback will give rise to deemed dividend under Section 222F. However, deemed dividend under 222D is limited to the extent of accumulated profits. 222F does not have that clause, and therefore in those type of instances, F may be a better option rather than D would be a better option rather than F. But as I said, those would be very limited cases where there are no accumulated profits, and then still there is a buyback. Now, what if the shares are held as stock in trade? Now, if the shares are held as stock in trade, there's an interesting decision which I mean just point out. The decision was in the case of Jai Hind Investments, Calcutta High Court, which has dealt with 2 or 3 situations relevant even for this amendment. You see, there the SSC had purchased certain shares of a company at 37 rupees. So the purchase price was 37 rupees per share. The face value was rupees 10. And the buyback price was rupees 40. Okay, so what the SSC did in that case was, this was a case of a reduction. So they said that the bank bought back these shares in pursuant to a scheme of capital reduction at rupees 40, and the SSC had claimed that excess realization of the face value as dividend and claimed ATM. So what the SSC did was that the buyback price of 40, which gave him 8,05,000, and the face value, the difference between these two is that item C over there, 6,04,000, he offered that as dividend under 222D reduction of capital. And at the same time, he claimed a loss. He said that, look, I have purchase price of 7,45,000. My face value is 2,01,000. So he claimed a loss of 5,43,000. So net, therefore, he offered 60,000 to tax. The matter traveled till High Court. Then High Court said that, look, when we are calculating dividend, I will not give you the deduction that you are claiming of 2,01,000 rupees of the face value. The dividend is the full proceeds that have been given to you. So the full 8,05,000 is treated as dividend. However, your entire purchase price, because there is a reduction of capital, you got that. Therefore, the entire cost of purchase is gone. It was held as your stock in trade. Now that stock in trade does not remain, and therefore the entire purchase price is given as your loss. So effectively, therefore, 8,05,000 is treated as my income as dividend under 222D reduction. The same would apply in a buyback, but that would be under clause F. And because it is a stock in trade, the entire cost of 7,45,000 in this case was given as a reduction. So net, even the High Court taxed it at 60,000, but the calculation is different and probably more logical. So the effect here is you apply this decision. This decision has also been followed by the Chandigarh bench and the Ahmedabad bench of the tribunal, the other 2 decisions. So the effect, therefore, of this is, friends, that if the shares are held as stock in trade, then that buyback, then the entire amount that you receive on buyback will be treated as dividend, but the entire cost of that stock in trade will be allowed as a business loss. So this is the impact if it is stock in trade. Interestingly, 46A does not apply. So the question is really relevant is that you are allowed a loss under 46A, which is capital gain chapter. So if it's a capital gain chapter and 46A does not apply to stock in trade, तो मेरे को मिलेगा कि नहीं was a question. When this amendment came in, that will the person who holds stock in trade, will he get a reduction or not, because 46A does not apply to them. So there the answer is yes, you will get it. You will get it under the head business itself as a loss. Then if a holding company receives, so then discussion on buyback in the hands of non-resident, we'll deal with it later. If holding company receives buyback price from subsidiary company, will loss be allowable? Here there's a problem that if a holding company receives a buyback from the subsidiary, the loss may not be allowed because 46A, because you see, between a holding and a subsidiary, the capital gain is exempt. If the capital gain is exempt, loss is also not taxable, and therefore 46A loss is useless in case of holding subsidiary relationship, and therefore this is a downside of this particular amendment. And one may have to take care, if a private company or companies are holding shares in a subsidiary, which is, which are subject matter of buyback. What happens in cases where shares earlier which are held as capital asset are converted into stock in trade? Let me explain this by way of an example. So Mr. A acquired shares of a private company during the year 2000, which were held as capital assets. Okay, these shares were later converted into stock in trade in 2022. The company bought back these shares in 24-25, and the facts are like that, like this. So asset acquired by Mr. A year 2000 amount 10,000. Fair market value in 2001 is 12,000. Conversion to stock in trade happened in 2022 when the fair market value was 1 lakh, and buyback happens in 24-25 as 1,50,000. So ordinarily, so therefore what happens? What is the gain which would have been, as a common sense, should be taxed? 1,50,000 is what I'm getting. 12,000 I should get. Fair market value of 2001 subject to indexation, etc. So 1,50,000 minus 12, 138 subject to indexation should have been my income. Now what is happening is whole of 150 becomes my dividend. Irrespective of whether stock in trade, whether it's capital asset, whole 150 is my income. So that is entirely treated as dividend income. Now, you had converted this into stock in trade way back in 22 before this amendment. But 45(2) says that we will tax that capital gain in the year in which that stock in trade is sold or otherwise transferred. Now there's a transfer, there's a buyback. And therefore that frozen capital gain becomes taxable in this year. And therefore the difference between 1 lakh, which is the fair market value on the date of conversion, and 12,000 becomes taxable in that year, right? So 1 lakh minus 12,000, 88,000 becomes taxable in that year. And therefore you say that, okay, 1,50,000 is fully taxed as dividend, 88 is fully taxed as my capital gain. So what happens? There the proposition will be like this: 1,50,000 fully taxed as dividend under 222F, 1 lakh minus 12,000, 88 taxed under 45(2) as frozen or suspended capital gain, and your cost of 1 lakh rupees, which is the fair market value on the date of conversion, that 1 lakh rupees you should be getting as a business loss following the decision of the Calcutta High Court, which we just saw. So net, your entire thing is broken into 3 parts. Dividend income 1,50,000, loss under the head capital gain 88,000, and loss under the head business 1 lakh rupees. This is how the complex situation will be while filing your return of income in such cases. So, okay. Buyback we have done. Yeah, in case of non-residents, the issues have arisen that, you see, if a non-resident is holding shares of an Indian company and there's a buyback, now what happens in that case? Because they would be governed by the treaty, right? Now the dividend definition under the Act has been amended. Okay, and therefore there was a prima facie view that when the dividend definition in the Act is amended, and if I'm governed by the treaty, then treaty or Act, whichever is more beneficial, should govern me. And therefore this definition does not govern me, and therefore buyback will still not be governed by, can still not be treated as dividend for non-resident shareholders. So that was the prima facie view. But when one looks at the definition of dividend in the treaties, under the model convention and most of the India's treaties, it has a very peculiar definition. You know, unlike your definition of royalties and fees for technical services, there is a very peculiar definition over here, which generally says, I've underlined in the UK case, I've underlined there, and more or less everywhere it's the same thing. So the term dividends as used in this article means income from shares or other rights, not being debt claims, participating in profits, as well as any other item which is subject to the same taxation treatment as income from shares by the laws of the state of which the company making the distributor is. So it says that what is treated by the domestic law as dividend will also be treated as dividend for treaty purposes. Okay, so this is the definition of dividend under the treaty. By and large, the language may be slightly here and there, but by and large, the treaties say the same thing. And considering this, therefore, if the domestic law considers buyback as dividend, the same would be the effect even under the treaty. Yes, the rate of tax may be different because treaty may have lower rate of tax, 10%, 5%, 20, whatever percentage is there. To that extent, there will be a difference, but otherwise, even for treaty purposes, it should be dividend. Sorry. Okay, now let's get into thank you. Okay, now there's an interesting situation. So we are out of the Finance Act 24 provisions dealing with these issues. We get into some other topics. And I selected the topic of trust because there's been always an issue. What is the status of a trust, how it is taxed, etc., etc. And I've taken a couple of interesting issues over here. So status, one thing to be noted is that a private trust, the scheme of the Income Tax Act is your specific trust, your discretionary trust. Specific trust, beneficiaries known, their shares known. Discretionary trust, beneficiaries either not known, not fully defined, or their shares are not known. Okay. Specific trust taxed under 161, like manner, same extent as the beneficiary. 164, trust tax is at the trust level, not at the beneficiary level, and tax is at the maximum marginal rate. This is a broad scheme of the income tax. Now, welcome, sir. What is the status of a trust, a discretionary trust or specific trust? And you have lots of authorities on the subject that if the beneficiaries of the trust are individual, the trust is taxed as individual. Trust is not taxed as an AOP, generally speaking. Trust can be taxed as an AOP under limited situation where, now what is AOP? AOP in law is that more than one person coming together to earn joint income or joint venture or something like that, that forms an AOP. So there's a common efforts, joint efforts, there's a joint income. Therefore, if people have come together and instead of forming a partnership or an AOP, they form a trust and appoint a trustee. Okay, that okay, if you do this joint activity for us to earn joint income. In such a case, that trust itself would be regarded as an AOP. But otherwise, where a trust, all the beneficiaries are individual, the status of a trust is of an individual because a trustee is only a representative of the beneficiary. And the beneficiary, each of the beneficiaries they have not come together. They have been appointed as beneficiary by some settlor who wants them to be benefited in future. So there is no common effort or joint effort, and therefore each of them are individual, and therefore trust is also an individual. There may be 10 beneficiaries, but the trust also should be an individual. So this is broadly the law, irrespective of whether the trust is discretionary or whether it is specific. Now, private discretionary trust tax under 164 as maximum margin rate. Interestingly, you have 115 BAC, which applies to individuals, HUF, and now they have clarified it applies to EOP, BOI also, that they will be taxed at the slab rates. Two interesting issues arise. What happens in cases where I earn long-term capital gains chargeable on 112 or 112A at a specific rate? Will that rate apply, or will my slab rate of 115 BAC apply? Second interesting issue, I am taxed at maximum margin rate if I'm a discretionary trust, right? Whereas 115 BAC gives you a slab rate, whether 164 will apply or this will apply. So these are the two issues. And why are these two issues? Let us quickly have a look at the provisions. Section 164, which governs the taxation of a discretionary trust, says that income or part thereof where beneficiaries are not specified or their shares are not specified, they are referred to as relevant income. Okay, Joe income, how much has to be given to whom is not known, right? They have defined it as relevant income in that section. Tax chargeable on relevant income, maximum marginal rate, right? And then there's a proviso which gives benefit to certain types of trust where, where if all the beneficiaries are below taxable limit, or the trust is the only trust which is created by a will, or it's a recognized provident fund approved superannuation type of a trust. To these trusts, MMR will not apply. A regular AOP rate will be applicable. And they are said as if the relevant income is the total income of the AOP. I think the words of the AOP has not come over there. So as if the relevant income, the tax shall be charged on the relevant income as if it were a total income of an AOP. So these are the exemption which has been given. So by and large, therefore, discretionary trust, relevant income charged at maximum margin rate. Proposition number 1. Proposition number 2. 112, the total income of an SSE includes an income arising on transfer of a long-term capital asset. Tax payable shall be 20% or a 12.5% as per the new law, whatever long-term capital gain applies, right? So that is this way. 112A, where the total income includes income chargeable under that capital gain arises on transfer for long-term capital asset when equity shares, STT paid on acquisition and transfer, tax payable shall be 10%. This is the law. Now, here comes the twist. 115 BAC. What does it say? Notwithstanding anything contained in this act, but subject to the provision of this chapter, income tax payable in respect of the total income of a person being individual, HUF, EOP, BOI, or artificial juridical person, tax shall be payable at the slab rates provided in the section. Right? So two issues here. First, notwithstanding anything contained in the act, and second, subject to the provision of this chapter. So let's deal with the second issue first, because the small issue easy to be dealt with. So issue is that since 115 BAC is made subject to the provisions of this chapter, and your 111A, 112, 112A, etc. are all part of the same chapter, that is chapter 12. Therefore, those provisions will prevail over BAC. And therefore, if my capital gain is chargeable at 12.5% under 112, it will continue to be charged at 12.5%, and I will not be governed by the slab, despite notwithstanding anything contained in the act. So, in other words, BAC will not override your 112, 111, 112, etc. That is clear because it is made subject to the provision of this chapter. So, first issue, easy to be dealt with. Now comes the second and interesting issue. Yeah.
Somebody on a long-term capital gain of 7 lakh, private family firm. Another is saying VAT 7 lakh up to 7 lakh income system. Long-term capital gain of 7 lakh income. Not under the 150 million up to 7 lakh. So that is correct or?
So you will compute, so your long-term capital gains will be computed under BAC, under 112. Once you compute under 112, it will talk about total income, capital gain at this rate and the total income at that rate. You will still get the slab rate and that benefit under 112 itself.
Yeah.
right?
Yes.
So you will continue to get that rate.
But you will get only 3 lakhs.
You will get 3 lakhs.
Not new rating, not new rating.
Not 7 lakhs.
7 lakhs.
You will not get 7 lakhs. You will not get. Correct.
So there will not be no point in new rating, it will not come under new rating.
Will not come. That will not.
That's the point.
Correct. Okay. Now the second issue that there is a discretionary trust which 164 tells you that it will be taxed at maximum marginal rate. And the discretionary trust is you either take it at individual or AOP to both 115 BSE will apply. So the question is, will 164 override BSE or BSE will override 164? Which one will override which? If you read BSE once again, it said notwithstanding anything contained in the act. So it overrides everything. And therefore 164 gone out of the window, bhul jane ka. All discretionary trust will be taxed at the slab rates. No MMR, forget it. Is that the possible interpretation? Prima facie, that is a possible interpretation. And I had an occasion to meet senior counsels on this particular issue. And the prima facie view of 2 senior counsels was, yes, 164 is useless now. But then once you get into more research and more discussion, it appears to be difficult to take that view ultimately, because there's a line of thought process over here that BSE deals with taxability of total income. Okay, because it says income tax payable in respect of total income of the person being so and so shall be so and so. It talks of total income. Whereas 164 talks of relevant income. Relevant income. They have defined relevant income as income which I do not know how much to give to which beneficiary. That is defined in the section as relevant income. And the section also itself says that in certain situation, relevant income will be deemed to be total income. So it deals, so that is that exemption, that proviso, which I'm dealing with here, which I pointed out here. If the beneficiary are below tax, then the tax shall be charged on the relevant income as if it was a total income. Okay, so the law has made a distinction between relevant income and total income. Relevant income could be part of total income. It's a subset of the total income. You can have a situation in a trust where the settler would have said that, look, a part of the income is discretionary and the part of the income is specific. Okay, ये dividend, ये share से जो dividend आएगा, it is discretionary. Let the trustee give to whosoever he likes, whatever he likes. But इसमें जो FD से interest आएगा, that has to be given to my son A, B, and C in this proportion. Possible. We have such trusts which are a mixture of both. So the MMR in those cases applies only to the discretionary portion. It will never apply to the specific portion. So therefore, therefore, 164 deals with the concept of relevant income, whereas BSE deals with the concept of total income. That being the position, the notwithstanding provision cannot apply because it will apply to the relevant. So the law therefore is that the two provisions operate in different fields. 164 applies to relevant income, BSE applies to total income. There are two different fields where they are applicable, and therefore they will continue to operate the way they are operating today. So 164 will continue to operate in the field of relevant income. When that relevant income becomes part of total income, that's a different topic. But so therefore, the notwithstanding provision will not apply to that relevant income. That's one. Non-obstante clause would override only those provisions which operate in the same field. For this proposition, you have a couple of decisions, Supreme Court, Allahabad High Court. Again, if you look at the budget speech of 2020, when BSE was introduced first, it talked about simplification of law, it provide relief to middle class taxpayers, and then the comparison table of existing tax slabs, slab rate, etc. was given. And therefore, it's very clear that it's not intended to cover cases of exceptional cases like 164. Okay. So budget speech, we are taking a recourse to it to see what is probably the legislative intent. And why am I seeing that? because the decisions that non-obstant clause should be interpreted having regard to the legislative policy. Non-obstant clause must be given effect to only to the extent the parliament intended to and not beyond. So for this proposition, you have authorities of Supreme Court on this. So therefore, to my mind, the better view is that BSE will not override section 164 despite a sweeping language notwithstanding anything contained here. Okay. So that is so far as this is concerned. Another aspect on the trust is a very small but a very important common error that we tend to make is that the father settles the shares of his private company into a trust. And he makes himself a beneficiary and his children the beneficiary and his wife the beneficiary. Right? Why he says that and it is a discretionary trust. So the point is, okay, मेरे को will नहीं बनाना पड़ेगा. If I make a will, there can be problems, there can be some challenges. I better create a trust today. So during my lifetime, I'm the beneficiary anyway. I'll enjoy the income. After my lifetime, the other beneficiaries will be there, and therefore he creates that structure. Now, this structure has a fallacy in the sense that to the extent he enjoys the income, fine, but to the extent the income goes to the children or goes to his wife, then there can be a problem. And the problem is this, that, you may call that trust as an irrevocable trust. The father has settled it irrevocably. However, you have in the Income Tax Act what is some concept of deemed revocability in section 63. And section 63 says that if the trust has a provision for retransfer directly or indirectly whole or part of the income or assets to the transferor, or if the transferor can assume power once again, then it's a deemed revocable trust. So if the settlor is himself a beneficiary of even part of the income, okay, then it becomes a deemed revocable for tax purposes. Now, if it becomes deemed revocable, what is the consequence? Consequence is in section 61, which says that all income arising to a person by virtue of a revocable transfer shall be chargeable to tax as income of the transferor. So therefore, whatever dividend income will flow from those shares which are settled by the father, even if it is distributed to various beneficiaries, everything will still be taxed in the hands of the transferor, that is the father. Okay. And if one is going to plan for estate duty, suppose, okay, some inheritance tax or something will come in the future. So once again, there's a flaw in this that, if you are yourself a beneficiary, then your interest is passing on the death, and therefore you are not saving anything on the estate duty. Okay. And therefore, and therefore this sort of a trust should be avoided. The settlor or the person who contributes his asset to the trust should himself not be one of the beneficiaries. He may keep, to the extent he wants to enjoy income, he may keep it separate, he may give it by a will, or he may create some other structures of, like voting shares, non-voting shares, etc. He may keep voting power with himself, and he may give non-beneficial interest to the others, etc. But do not put it in a trust. Do not make yourself a beneficiary in the trust because of this issue. So this is, I think this is a common mistake which I thought I should point out at this forum. That takes us to a controversy on ESOP, which are two recent, very, very recent decisions of 2024. On the same set of facts, two different high courts taking two different views. One, what are the facts? There's an employee of an Indian company. Okay, he was granted ESOPs by an ultimate parent company, which was in Singapore. That Singapore company divested one of its significant businesses to some third party. So as a result of the divestment, what happened was that the value of the shares and the value of the ESOPs which these employees were holding got diluted. It got eroded actually, because a major part went somewhere else. So the employees obviously did not get the shares of that other company where the business was divested. They did not get. And their value got eroded. And therefore that Singapore company decided, okay, I need to compensate all the employees. Not just the Indian employees across the world, they had various subsidiaries, etc. So they announced a compensation, that the compensation will be paid by the Singapore parent to the employees of various subsidiaries or the second tier subsidiaries across the world. So they decided a compensation to pay it. And in that announcement, they said that we will do a tax deduction for the Indian employees. We will do a tax deduction under section 192 as salaries. So in India, 2 of the employees went to the court. Others must have also gone, but what is reported are 2 employees went to the court for taking a direction of. So first they went to the tax department for a 197 certificate. Tax department did not grant 197 certificate. So therefore, both of them filed writ petitions. One filed in Delhi High Court, the other filed in a Madras High Court. Now, the question was whether this compensation is chargeable to tax as salaries under 1726. 1726, as you all know, taxes ESOPs. There was a question before the court. First came the Delhi High Court decision in Sanjay Baweja. What it says is that ESOP is taxable as salaries only upon exercise. अभी ये employees ने तो exercise किया ही नहीं है. Those options that they were holding are they continue to hold those options. They can exercise anytime in future. They have not yet exercised. Okay. So therefore, the taxing event under 1726 has not yet come. So 1726 not applicable. Then employee has not exercised the option. 1726 not applicable. Then he says that compensation is one-time voluntary payment by the Singapore company. It is, they've somehow taken a view that it is not here. Thank you so much. It is, they've taken a view that it is not linked to employment. And why? They said that look at the announcement. Announcement clearly says that there is no legal or contractual obligation to pay this amount. And therefore, it's a voluntary payment. It is not charged. It is not in the nature of income at all. And for this proposition, they took recourse to the principles laid down by Supreme Court in that Padma Raje's case, and which in turn approved the Bombay High Court decision in Vijay Kuvarba Sahib's case. And they said that it's a voluntary payment, ex gratia payment, not in the nature of income, not chargeable to tax. This is a view taken by, and in fact, Delhi High Court says that since tax was already deducted by the time matter went to the court, matter was heard by the court, they said that the petitioner should, the department should consider the application for refund of TDS to them. Okay. Then came the next matter in the Madras High Court. Exactly the same company, same everything, same. There, the 194, interestingly, the 197 order of the AO makes a note that while it is agreeable that a compensation is not chargeable to tax as salaries, it is taxable as capital gain under section 45. Because there's an extinguishment of right, and then therefore there's a capital gain, and therefore we said no, let them deduct tax at source. The matter went to the Madras High Court. What did Madras High Court says? Madras High Court, after elaborate discussion, they said it's not capital gain, it is not a right, etc., etc. Whatever. Ultimately, they said that this is a salary. It says the expression value of any specified security transferred directly, indirectly, free of cost, or at a concessional rate. That is the language of section 1726. So it is wide enough to encompass the discretionary compensation paid to ESOP holders to compensate for the diminution in the value there. So they have taken this view that this expression is wide enough. You may not have computation mechanism that is not necessary, but this expression is wide enough, and therefore it will be treated as salary. They said that we do not agree with the decision of Delhi High Court, dissented from Delhi High Court decision, and then ultimately held, although the AO's rationale of rejection is not right, because AO had said it's capital gain, and therefore they rejected. That AO's rationale is not right, but nonetheless the rejection is right, so they upheld the rejection. So these are the two contradictory views. Now, what seems, I mean, in this gathering, what seems to be a better view? To my mind, the Madras High Court seems to be a better view. You see, if you take a view like Delhi High Court, it's a voluntary payment. Then what happens to 56,210? If it's a voluntary payment, then it's without any consideration. If it's not without consideration, it will anyway be taxed under 56,210. And the amounts are definitely more than 50,000 rupees. right? So amount received by an individual from any person, everything will be taxed. So that's one downside of that decision. Secondly, there is an interesting element which has not been discussed in either of these two decisions, that if there is an erosion in the value of an asset, then the erosion in the value of an asset is not arising out of transfer. Compensation for an erosion is a capital receipt. There's no transfer. Okay, now that proposition you have Supreme Court in Sirpur Mills case. I didn't have the citation easily available last night. So there, so erosion, and that is why you have this section 45(5)(a), which says that if there's a damage to an asset and you get something in consideration of damage like floods, typhoon, etc., then that will be chargeable to capital gains tax. Why was it required? It was required because a mere damage to an asset is not a transfer, it is otherwise a capital receipt not chargeable to tax, and therefore they needed this section 45(5)(a) of the statute book. But that is only for those limited situations where an asset like a plant machinery, etc., is getting destroyed or damaged by fire or by typhoon or flood. There, that provision will apply, not in cases of all other erosion in the value of assets. So, but that theory not discussed at all. And for all practical purposes, a foreign company, it's not coming out clearly from these decisions, but a foreign company would generally take a recharge from the Indian employer. That if it's your employee, you recharge that amount back to us because it's your cost. It's not coming out clearly, and if it's a recharge, certainly it is by the employer himself, not even by somebody else, and therefore it would once again be a case of salary. Considering the overall thing, I think Madras High Court is a better view. And to plan that it's not chargeable to tax at all would be pretty adventurous. Then there are some three decisions which have interestingly taken a view that ex gratia compensation on termination of service is not taxable. 17(3), you see, defines profits in lieu of salaries. Here 17(3)(1), which says that amount of any compensation due to or received from employer or former employer at or in connection with termination of employment or modification of terms thereof. So compensation due to or received from employer or former employer at or in connection with termination. So that compensation word is important here. That is taxable under 17(3)(1). So now you have these three case laws, starting with Gujarat High Court of 2015 and followed by Ahmedabad bench in 2024 and Bombay bench earlier in 2021, where they have taken a view that ex gratia compensation on termination of employment is not taxable under 17(3)(1). Okay, so in those cases, probably the income completely escaped assessment, completely escaped tax at all. It was held that the severance pay received by an employee on termination of employment is not taxable as 17(3)(1). It was ex gratia voluntary. What is said was compensation presupposes an obligation. There has to be a quid pro quo. I compensate you for something. Either your rendering of service or your loss or something is getting compensated, right? So that there is if there's an ex gratia or voluntary payment, it is not compensation, and therefore 17(3)(1). So that was the earlier Gujarat High Court in 2015. However, you have and that 2015, although it was Gujarat High Court in 2015, it was concerning some years, 1997, 98, some such assessment year was there. In that context, they took a decision, and probably at that point of time, it was the right decision. However, you have 17(3)(3) in the statute book, which is introduced from 2002, okay, which says that any amount due to or received from any person before joining employment or after cessation of employment, any amount. It's a very widely worded provision, and that, to my mind, would mean that such type of compensation, whether it is compensation, not compensation, anything ex gratia, whatever it is, any amount received would be profits in lieu of salary chargeable under 17(3)(3). Now, of course, Gujarat High Court didn't have occasion to examine this because Gujarat High Court was for a year prior to 2001. But the subsequent two decisions, Ahmedabad Tribunal and Bombay Tribunal, in the subsequent two cases were of years after 2001-2. But somehow they have not discussed this. Nobody pointed out. They simply followed the Gujarat High Court and decided the issue in favor of the SSC. So before you get your client to say that, look, this is not taxable. Look, somebody told me that this is the decision. Better be careful that these decisions do not discuss 17-233 at all. Then, how much time we have? Half an hour. Okay, a few interesting issues. Property or shares distributed by a private family trust to a beneficiary. Subsequent sale thereof by the beneficiary. What is the cost of acquisition? What is the period of holding? Okay. So, when a property is put into a trust, you have provisions in section 47, 49 to say that the cost to the previous owner will be deemed to the cost, etc. But when it goes out from the trust to the beneficiary, you don't have any provision in 47, you don't have any provision in 49. Okay. So what is the correct position? So a person, Mr. X, say for example, has settled some property into a trust for the benefit of the minor children. Those minor have become now major, and after it has become major, the trustee distributes those property to the major children. Trust comes to an end. Simple example. What happens? Next day, that son who has become major, he receives the property. Next day, he sells that property. In his hands, whether it's long-term, short-term. What is the cost of acquisition? Lot of theories. Cost of acquisition, I have received it free, therefore no cost of acquisition, no capital gains, forget it. One theory. Second theory, the market value on the date on which I have received it becomes my cost. Supreme Court in Gross Wickert, Sabu said that, and that was the authority on that subject, that if I receive something, then my cost is the market. If I receive something free, then the market value on the date of receipt is my cost, and therefore that I get as a deduction. Second theory. Third theory, of course, you look at the cost to the previous one. So these are the three theories that you have. And in absence of specific provision in the Act to deal with this questions become important. So how does one logically look at this? What is a trust? And who is assessed? You have section 160, which says that a trustee of a trust is a representative of the beneficiary. So really the asset and the income belongs to the beneficiary. But that beneficiary is represented by the trustee, and therefore trustee is taxed. And there is the option given in the law for specific trust. Trustee could be taxed, beneficiary could be whatever it is. Right? But therefore, who is the real owner? The beneficial owner, the beneficiary. Now, therefore, when that father had settled the shares in the trust, when the children were minor, who were the real beneficial owners? The children. They were always the owners from that day onwards. The trustee was only a trustee, fiduciary capacity. So therefore, cost of acquisition in the hands of the beneficiary is nothing but the cost of acquisition in the hands of the trust or the settlor. If the trust has received from the settlor, it's the settlor's cost. If the trust had suppose acquired that property in the at some time, then the cost of acquisition of trust, because the trust acquired the property from monies belonging to the beneficiaries ultimately. Right? So therefore, even in absence of a specific provision, one will have to look at the cost of acquisition to the trust or the cost of acquisition to the settlor or the contributor, as the case may be. And therefore, logically, the period of holding by the trust or the period of holding by the person who settled those shares or settled that property will have to be looked into. So that's to my mind, the correct position, despite there being no specific provision in the Act to deal with this. Then you have a situation where shares received by daughter-in-law from mother-in-law as gift. Somebody will say, "Kaisa hota nahi hai," lekin I'm giving that example. So shares received as a gift, subsequent sale of shares by the daughter-in-law, proceeds used to buy a house in the name of the daughter-in-law. And the question is, what happens to the exemption under 54? So a mother-in-law, daughter-in-law, or father-in-law, daughter-in-law, son's wife, that is what section 64(1)(6) says. It says that all income that arises to son's wife from the assets transferred otherwise than by way of adequate consideration will be taxed in the hands of transfer. So the clubbing provision comes. So if that daughter-in-law has sold the shares, the capital gains will be chargeable in the hands of the mother-in-law. 64(1)(6), absolutely clear, no doubt about it. Income includes, because income is defined, it says all such income as arises to son's wife. Income includes capital gains by definition under section 224(6). And now comes the issue that 224 says includes income under section 45. What does 45 say? 45 says, save as otherwise provided in 54, 54 EC, 54F, etc. Income will be chargeable in the year of transfer. Right? So 45 is save as otherwise provided in 54. So therefore, before coming to 45, or rather while calculating capital gains under 45, you will have to give effect to the exemption provisions. And therefore, if the daughter-in-law has purchased a house and sold the shares and purchased the house, so you first compute capital gains in her hands. How will you compute capital gains? The gross capital gains minus 54 exemption, net capital gains, you compute that. Having computed that, it gets clubbed in the hands of the mother-in-law. So therefore, what gets clubbed is the net capital gain and not gross capital gain is the correct legal interpretation or position on this. Of course, if the daughter-in-law is otherwise entitled to deduction, etc., then he gets it. And you have a few authorities, not directly on this issue, but giving these principles, you have these 4 or 5 authorities which I have cited here. Then, then there are interesting situations for the purpose of claiming section 54F, where you are told that if you sell land, if you sell shares, and if you buy a house, you get a deduction, but you should not be the owner of more than one house. So therefore, if I am the owner of more than one house, and I want to sell the shares, I want to sell a plot of land, and what do? I transfer it to somebody in the family by way of a gift. Okay, and questions arises that if you transfer it within the family by way of a gift, what happens? You will be entitled, you will not be entitled. So 2 decisions, line of decisions on this. The first one is the Hyderabad bench decision of 2023, where the son had, there was a gift from son to the father just before he had sold his plot or shares or whatever it is. And therefore he became, from 2 houses, he became only owner of 1 house, and therefore he claimed exemption for the new house after selling his other long-term capital asset. So here the Hyderabad bench took a view that no, this is nothing but tax avoidance gimmick. This is only a device to avoid your tax, and therefore we will not allow you this deduction or exemption under section 54F. And while doing so, they had a an observation which will convince all of us that this is nothing but a device. It looked at the fact that the stamp duty on that gift deed was actually paid after the sale transaction took place. Okay, so you sold the shares or plot, whatever it was, earned capital gains. At that time, you realized, "Arey baap re, mere ko 54 nahi milega." So therefore, I made some old backdated gift deed, gifted to the father, paid stamp duty on that gift deed at a later point of time. So that was one very strong point which went against the SSE over there for the tribunal to say that this is a tax avoidance device. Then they also padded up by saying that son continued to live with the father even after the gift. Gift was just a few days prior to the transaction, etc., etc. And therefore they held that 54 is not allowed. 54F was not allowed. This is one decision. And of course, in the GAR days, one will have to be definitely careful of all these sort of things. You also have a 2015 decision of the Mumbai Tribunal where there was a gift from wife to husband. And there was a legal issue also over there, apart from this factual issue of whether it's a device or not. So there also assessing officer said that after the wife gifted to the husband, they are both anyway living together in the same house, etc., etc., and therefore we are not. It's only a device. It's only a gimmick. But apart from that, they also said, the department also said that look at section 27. 27 says that when there's a transfer of a house from to a spouse without adequate consideration, then the transferor will be deemed to be the owner for the purpose of house property, and that transferor is still showing the income from house property in his hands. So there is the question of not being the owner. So that was department's one contention. And also they looked at section 64, which says that any income which arises to the transferor spouse will be taxed. Sorry, income which arises to the transferee spouse will be taxed in the hands of the transferor. So they looked at these two provisions and said that therefore there is the owner for both these purposes, is also owner for the purpose of section 54F, and therefore will not allow. The tribunal said that no. So far as device is concerned, they took note of the facts and said that there is a proper registered gift deed, etc. You cannot ignore the fact that there is a proper registered gift deed, etc. On the point of law, they said that look, 27, which deems the spouse to be the owner, very clearly says that for the purposes of section 22 to 26. It is not for any other purpose. So therefore, you can't extend that deeming provision also for the purpose of 54F. So far as 64 is saying, they said 64, it is the income from that transferred assets that you have to look at. Here we are not talking of income from the transferred asset, we are looking from income from some other asset. So therefore, 64 also has no application, and that is how the Bombay Tribunal in that case decided the issue in favor of the SSE, despite the fact that it was a gift from wife to the husband. And that has been once again followed by the Delhi Tribunal in the last decision which I was cited. So therefore, friends, whenever this sort of plannings are made, one will have to be very careful. One will have to be little circumspect. Look at it with close this thing. Look at it with from the eyes of a toughest tax officer, and make sure that you don't falter on any of your documentation and things like that, and build around some good purpose for your transactions by way of gift, etc. So, why purpose? Because ultimately these are prior to the GAR days. Now you have this added animal called GAR, and therefore if you give some purpose and therefore the department should not be able to allege that this is merely for the purpose of getting a tax benefit. Right? Conversion, yeah.
That's the question. Father and mother, right? The three children were separated before the father died. The family of father, mother, and three children. The children separated before father and mother died. The other died in particular year, he got all the property to the mother.
Build away everything.
Subsequently, his mother was again. She will get the property to the
Children.
Now, one child would have got more money than other children. The girl got more property than the children. There was a family agreement, not a different agreement, but a settlement. Saying that sister will give certain amount of money to both the brothers as a gift. So all of them have declared shares of the limited company. The registered companies were voting in this organization. Now, see, the parents were separated with the children. The property came from the children. Subsequently, they sold those shares. One from the amount they got under the rule, and another from the gift they received from the sister. The question is about the cost of acquisition, because they are separated, father and mother were increasing the shares, the children never knew what was their cost. So now how do you work out the capital in the hands of the transferee? The children will just sell the shares.
That's a matter of fact, you see.
But then, see, as a child, I don't know what to the cost. They must have budget in their framing of fact. So the mechanism fails to calculate capital gain.
So in that case, 2001, if you have benefit of 2001, you get the benefit. It was no. When was it acquired? When did, if there are shares of property, you will always have the date of acquisition. If there are shares, you will always know when they were acquired. No, but when was it registered in the name of your parents? When were the shares registered in them?
He's supposed to say when they purchase.
Shares, either demat account or physical account.
Just take a one more slide. But I'm getting on the fact that we make minor purchase after me also. What do we do? Must be between 21, 22.
So I think it's a matter of fact. One will have to get into it. Right to the company, they will know when were the shares are. Right to the company. I mean, right to the company, right to the register. These are factual issues. Okay. Right. Now, let me deal with quickly one of the issues which is in discussion in the current days. See, there is a large public listed company which had issues DVRs, that is shares with differential voting rights. So they had two classes of share, equity shares, but two classes of equity, normally regular equity and shares with differential voting rights, right? They were issued some years back as bonus shares to all equity shareholders. And the question was that they found that both were quoted on the exchange, but they found that the DVRs are quoted at a very great discount as compared to the regular equity shares. And therefore, in the interest of all the shareholders, the company wanted to convert those DVRs into equity shares. Now, therefore, the question arose, what are the tax implications of that? Now, that particular company, I mean, the scheme just happened 2-3 months back, where where first of all, you find that in the company rules, there's a rule 4.3 of the company share capital and debenture rules, which says that conversion is not possible. I can't convert equity to DVR and DVR to equity. I have to issue new equity. So that is not possible. So then, therefore, how did this company do it? So they mooted a proposal that they will first do that they will do a capital reduction of the DVR. So DVR will be purchased back or bought back and the capital reduced. And fresh new equity shares will be issued in consideration of that buying back. Okay, and for all this mechanism, a trust was formed in between. So that every shareholder would sell the shares to the trust, and then the new shares will be issued to the trust, and the trust will then surrender the shares, etc. So this was the mechanism formed. So purchase and issue in consideration of that purchase. So what are the tax implications of that? Because that tax implication is on the company, not on the company, it is on all of us as individual shareholders. So tax implications are reduction of capital is deemed to be dividend, and in the company itself told in the announcement that we will do a TDS as per dividend. So it's deemed to be dividend, and this dividend, of course, this dividend ultimately will become cost of acquisition as and when those new equity shares are sold. But then your fresh period starts from today for that new equity share. So these are the tax consequences of this particular transaction in short. Is there an alternative to this is what one is debating. And probably one can think of a better alternative than this particular mechanism. And that could be by invoking provision of section 48 of the Companies Act, where there's a provision for variation of rights. And this section says that when a company has more than one classes of shares, then the rights of one of the class can be varied. And if that is going to affect the other class, then the meeting of both the classes of shareholders is required. So therefore, you vary the rights of the DVR holders and make it pari passu the equity shareholders. It will affect the equity shareholders and therefore have a joint meeting of everyone and do it. That could be a better option because variation of rights, there is no transfer. Unlike reduction of capital, which is deemed to be dividend, there is no such deeming provision as dividend or anything of that sort because you are not getting anything. All that you are getting is an improvement to the value. There is improvement to the value of the equity shares or DVRs that you are holding. So a variation of rights possibly could be a better option. Under the law, variation need not be through the NCLT route. It goes through the NCLT only if somebody wants to scuttle the some shareholder. And totality of the shareholders, more than 10% want to scuttle the whole issue or whole conversion. they may do it through NCLT, but otherwise NCLT is not required. But nonetheless, it is advisable to go through the NCLT route for the sake of transparency, governance, or whatever. So this probably is a better option, and some companies after this event who are planning now to do is are really exploiting the route of variation of rights, so as to this thing. So these were some of the current issues which I thought we can share, and there are a few slides on what happens when an individual dies for tax purposes. You have section 159 and you have section 168. So 159 operates for the income prior to the date of death. 168 operates for the period after the date of death. And the income prior to the date of death is assessed in the hands of the legal representative under 159, and income up to the date of death. And therefore, that is as if that person was alive. It will be taxed in the hands of the legal representative. And therefore, logically, it will be the same PAN of the deceased. And how do you enter the same PAN of the deceased? You enter through your portal. The legal representative will enter through his portal, and then there's an option of in his capacity as a legal representative. When he goes there, he will have to submit certain documents to the CPC. As per the list, if he submits the documents, it takes 3 or 4 days to clear it. And once he clears it under the same PAN, he's entitled to file the return of the deceased. So that is only up to the date of death. After the date of death, if the person has left a will, then it's the executor of that will who becomes the assessee till the time the estate is actually distributed. Okay, and because distribution might take some time in larger families, etc., and therefore till the time distribution happens, the income gets taxed in the hands of the executors to the estate, and which is under section 68. So the income from the date of death till the date of distribution is taxed in the hands of executor under section 168, and that is a separate entity, and therefore there will have to be a separate PAN which will have to be obtained by the estate. And once again, whatever documents needs to be furnished will have to be furnished for the purposes of this. The executor may also have to have a TAN, may also have to have a PAN, will have to have a PAN. And because otherwise all your shares, bank accounts will not be able to transfer. You'll not be even able to operate that account to transfer from the deceased account to your account to the executor's account. And how do you do that? It becomes impossible. So this is how, and somehow, in case of transmission through will, people miss out on filing returns of the executor. And it is only after 1 or 2 or 3 years, when everything is sort of distributed, then probably the legatees will start offering the income from there later on. Until that time, I've seen cases where actually the returns are not filed. It has actually escaped assessment, and serious consequences follow. So one will have to take care of 159 and 168, and then after distribution in the hands of the legatee. Yeah.
What about TDS deducted in the name?
So if TDS is deducted in the name of the deceased, for the period prior to the date of death, there is no question he'll get the deduction. If it is after the date of death, then nowadays what we do is we follow the route of 37BA and give the declaration that this income is taxable now in the hands of the estate, and therefore TDS should be in the hands of. So once you follow that route, I think things become simple. Okay. Yeah.
Hello?
Yeah.
So how basic attention will be split in this case?
Sorry.
Basic attention limit
For
in case of life.
For the executors?
Yes.
So, okay. So for the executor, what section 168 says is that if there is one executor, he'll be treated as individual. If more than one executor, he'll be treated as an AOP. So as an individual or as an AOP, he gets that basic exemption as per the slab rates which are applicable. And it's only a deeming fiction, and therefore that maximum margin rate which otherwise applies to AOP will not apply over here, because it's by virtue of a deeming fiction that it will be treated as an AOP. There are no members of that AOP otherwise. Okay. Some case laws not 168 is not applicable in case when there is succession in an intestate succession. It applies only when there is a will and an executor is appointed. Legal heirs are assessable only after distribution. Executors would be assessed till distribution. Income prior to distribution is assessable in the hands of the executors alone. This is an interesting one, MP High Court, which says losses of earlier years carried forward in the hands of the deceased can be set off against the income of the estate. This is 133 ITR MP High Court, an interesting decision, which can sometimes be of help. Okay. So, 2 or 3 small issues on section.
If it is not a will,
Then directly the legatees will have to file their returns. Because then it goes that intestate succession, the law takes its own course. As per the law, whoever are the legatees, then they will have to. So, okay. Section 79, I have picked up some 2 or 3 issues. Let me quickly deal with that. Yeah.
Basically, which we are seeing also, anytime dead person returns a significant fine.
Sorry.
The data is the data correct. 2-3 years. Practically, what we are saying, suppose a person holding the share, okay, they are applying the further right or something in the name of dead person only, getting the shares also, and continue to file the return also in the name of dead person for 2-3 years. Finally, when the distribution of assets happening, then only they set up top.
It's wrong. It's wrong.
Practical happening.
It's wrong. It's wrong.
What is consequence in that?
So it's, see, if there is no leakage of revenue, then maybe it may practically sail through. But it's giving a false evidence. You're not giving the details to the department which ought to have been given. It's
Because it doesn't include that person, it's a legal head. The documents are not sufficient. They are asking for some things. Actually, it's not possible to apply get those documents after the legal. So what people are doing is, it not goes through OTP, right? People are filing the name of the dead person with mobile OTP available to the legal heads. Pay the tax. No, that's not that.
that's all wrong. That is absolutely wrong. You can't, I mean, you are signing on behalf of somebody. A dead person is signing. So it's wrong. So had it been a physical return, who would have signed it? Had it been a physical, you are saying that a dead person is signing that return. Okay. Okay, quickly, 3 issues on section 79. One issue is when there is an internal restructuring. So 79 essentially says what? That if more than 51% shareholders of a private company, beneficial owners of the private company changes hands, okay, the losses will not be available. Now there could be a situation where company A is holding company B and company, or say family is holding company A, company A is holding company B, right? And there is a change in between. Instead of A holding B, it will be C holding B. But ultimate holder of C is also the same family, right? So, can you say that the section talks of, what does it say? It says that persons, not less than 51% of the voting power were beneficially held by persons who beneficially held the shares of the company carrying not less than 51% of the voting. So can you say that the beneficial shareholders are the same? Ultimate holders are the same, and therefore there is no change in the shareholding, and therefore 79 will not get triggered. Can you say such a thing or not? Is a question mark, right? Now, you have 2 lines of decisions on this. So in short, if I can just paraphrase, is the shareholder of a shareholder a beneficial holder? Or is the immediate shareholder the beneficial holder? Right? If you take a view that the shareholder of a shareholder is a beneficial holder, then the aggregate of the beneficial holders can be much more than 100%. It leads to that absurdity because there may be shareholder of shareholder of shareholder and there may be many shareholders. So it's an absurd situation if you say that the shareholder of a shareholder is a beneficial holder. It leads to absurdity. And secondly, under the Companies Act, all the rights are to be executed, are to be exercised by the shareholder, not by the shareholder of the shareholder. They may, by virtue of a shareholders agreement or your articles or whatever, they may govern the conduct amongst themselves. But it's the immediate right of the immediate shareholder, and therefore the beneficial holder is also the immediate shareholder, is what I feel is a correct legal position. However, you have that Karnataka High Court in MCO power, which has taken a view that the shareholder of a shareholder remaining the same. There is no change in beneficial ownership. 79 does not apply. You have Delhi High Court in Yam taking a different view. And there are a number of decisions taking the line of Karnataka. You have Ahmedabad Tribunal, you have Bombay Tribunal, and you have yet another Bombay Tribunal following that particular view. But interestingly, in the context of 48(2)(b, 48(2)(b), your related party, which also talks about beneficial owners. Language almost the same. There, the Bombay High Court in HDFC Bank's case has taken a view that the shareholder of shareholder is not a beneficial owner. The beneficial holder is the immediate shareholder. And therefore, you can't say that the shareholder of the two companies is the same and therefore they are two related parties. You can't say that. Right? And there they have elaborately discussed this proposition that it may lead to absurd results. The aggregate number of beneficial shareholders will be more than 100%, and so on and so forth. And they have looked at the provisions of the Companies Act as to who has to exercise the rights of a shareholder, etc. So this is one issue. Better view, to my mind, is that the immediate shareholder is the beneficial holder. So please don't be aggressive to plan out the affairs in such a manner that you end up into litigation. Yes, if you have already ended up into litigation, there's Karnataka High Court, which you can keep on arguing. Then the second situation is where I did some changes in the family shareholding without realizing 79. Okay. And then in the year of profit, I realized, अरे बाप रे, ये तो मेरा share loss lapse हो गया, क्या करूं? Can I revert back to the old situation and say that? So I've taken an example. In year 1, A, B, C, D are shareholders. 55, 20, 15, 10 was the holding. That was a year of loss. Year 2, I did some rejig, and that 55% shareholder goes out. And you have B, C, and D, 45, 30, 25 as the shareholder. So more than 51% has changed hands in year 2. But year 2 is also a year of loss. In year 3, there is a profit, and I realize, oh my God, what happened? Has my losses lapsed? Or at the end of year 3, I bring back the original position. Can I salvage? Right? Section 79 doesn't talk of lapsing. It does say it will lapse. It only says that if there's a change in the shareholding, then you have to compare the shareholding at the year end of 2 years. The year in which the loss was incurred and the year in which you want to set off. Okay? You compare the shareholding of these 2 years. If more than 51% has not changed, 79 not triggered. That's the simple, plain and simple language of section 79. One second. Where a change in shareholding has taken place during the previous year in the case of a company not being company public or subsidiary, no loss incurred in any year prior to the previous year shall be carried forward and set off against the income of the previous year, unless on the last day of the previous year, the shares of the company carrying not less than 15% of voting power are beneficially held by persons who beneficially held shares of company carrying not less than 15% on the last day of the year in which the loss was incurred. So 31st of March, 2 dates you have to see, year of loss and year of settlement. If that is not changed, or the change is not more than 51%, then you are good. So I would feel that looking at the plain language of the section, it is possible to reinstate and salvage. Of course, in this particular case, the loss of year 2 will not be available. Because those who are holding 51% do not hold 51% now, because B, C, and D put together are not holding more than 51% in year 3. So therefore, year 2 loss will go, but year 1 will still be available.
So that you can do it year 4, you go to year 2.
Interesting, yeah. So if you succeed in year 3, you'll succeed in year 4. If you fail in year 3, you will fail anyway. Okay. So, okay. Then lastly, if I've issued a convertible debentures compulsorily,
Carry forward the process.
so it says carry forward and set off. So carry forward and set off. That's the language used, but carry forward and set off. So it presupposes set off. If so, what is prohibited is carry forward and set off.
How we can?
A mere carry forward is not covered by the section. So therefore, you can carry forward. We can't set off. It talks of carry forward and set off. Okay. Okay. Then lastly, at times, for the purpose of 79, you want to structure something. You want to make somebody an equity shareholder, but you don't want the shares to lapse. And therefore, one resorts to issuing convertible instruments, right? So you may issue convertible instruments, convertible debentures, whether compulsorily convertible, whether voluntarily or optionally convertible, you can issue those debentures, but please don't give them voting rights. If you give them voting rights, then you're back to square one. Then there's a difficulty. But otherwise, there are ample number of authorities to say that a debenture, whether it's convertible or non-convertible, it is a debt and it is not an equity till the time it is converted. These are, of course, the decision in the context of allowability of interest and things like that. And but then it is a debt. If it's a debt, it's not shares. It's not shares carrying voting rights. But please do not give voting rights anyway, because then one may see through the whole thing and invoke GAR in those cases and say that this is only a sort of a it's sort of a form is different, but substance is different. Don't enter into that area. But otherwise, it's possible to structure it by giving convertible debentures. Lastly, last 2-3 minutes, if possible. Private limited companies converted into LLPs, and there could be situation where it's non-compliant, that, you know, I want to convert it, but I don't meet with the turnover limits and the you know, your asset limits. I exceed that limits, and therefore 4713B is violated, and therefore there's a problem. What happens in that situation? All your arguments that this is not a transfer, etc., we have all exploded and we have failed. Tribunals have taken a view that there is a transfer, rightly or wrongly. And then when the matter goes to the High Court, we will see what happens. But today the law is that if it is non-compliant, there's an issue. Now, if there is an issue, then what happens? So far as the company is concerned, so there are two entities you have to look at. Company converts into LLP. So far as company is concerned, it is no more in existence, number one. So far as company is concerned, it has not received any consideration. In absence of consideration, there cannot be any capital gain. And therefore, so far as the company is concerned, the risk of capital gain or any tax in the hands of the company is almost ruled out. But you have shareholders who are the shareholders of the company. Now they become the partners in the LLP, and therefore in their hands, the shares got extinguished, and in consideration, they got the interest in the LLP. So in their hands, there's a capital gain which happens in the hands of the shareholders. In the past, till last 1 year or so, I had not seen cases where the department was invoking tax in the hands of the shareholders. They were only looking at the company. Okay, but now they have started looking at even the shareholders because they realize that in the hands of the company, they will not be able to get any tax. Now, in the hands of the shareholders, there is a transfer in terms of extinguishment of shares in return of getting the shares in return of LLP. Now here, interesting argument which we used to take in the past is that, look, the share in the LLP is a share in future profits, which I cannot measure today. And therefore, Supreme Court in Sunil Siddharth Bhai says that the consideration cannot be measured, and therefore capital gain charge fails and capital gain fails. Now that argument is now no more available because you have section 50D, which says that if you cannot measure the future profits and therefore you cannot measure the consideration, you have to look at the fair value of the shares that you are giving up. And therefore that fair value of the shares that you are giving up becomes the consideration for you. So, so to that extent, one will have to then pay capital gains tax in the hands of the shareholders. Now here the question is, how do I value the shares? Because if I have to apply 50D and do the valuation of the shares which I am giving up in order to compute capital gain on extinguishment of those shares, how do I value? Do I do a fair valuation or do I do a 11UA valuation? Because my 50CA allows me to do a 11UA valuation. And if that 11UA valuation, in case I do not have, I may have large goodwill and large intangible assets, because of which my fair value may be more, but 11UA value may be less. Then probably you can play around and say that, look, this transfer will still be governed by 50CA because it's a extinguishment or transfer of an unlisted shares. And 50CA takes you to 11UA, and 11UA valuation is this. I pay tax on that and finish the matter. So, although the fair valuation may be more, you may pay 11UA tax in the hands of the shareholder, and that one-time tax could be the consequence of this non-qualifying conversion of LLP. Okay, friends, I think I may close over here. For CA firms, I came across one board circular to say that if a partnership firm converts into an LLP, there is no tax. There's a board circular, you can take advantage of that. But according to me, as a matter of law, it's wrong, because if a partnership firm gets converted into LLP, if you say that conversion is not a transfer, then you're home. But if those tribunal decisions which have taken a conversion is a transfer, then there is a problem even if a firm converts into LLP. Okay, but then there's a board circular which says firm converts into LLP. LLP is also firm, therefore there's no transfer. Take advantage of the circular and convert your firms into LLP and finish it off. Then there are institute guidelines where CA firms merges, what happens, But when CA firm merges, that may be for the institute a merger, but there is no merger of partnership firms at all under the Partnership Act, and all the consequences of transfer and capital gains, etc. will follow. So that will also have to be done very carefully. Okay, friends, I think we do not have much time for that. Haji. Haji.
When we NRI sell the property, NRI sell the property, then the 20% period is applicable, as we know. Correct? But now the capital gain is 12.5%. Even if the 100% gain is there, then also 12.5 is applicable. 12.5% capital gain. But period rate is still a 20%.
No, wait a minute. So there's a non-resident Indian who is selling a immovable property. Okay, so if he's selling a immovable property, he will probably go for a 195 or a 197 adjudication. If he doesn't go, then the tax will be on the entire amount of capital gains tax. Your 194 IA will not apply to it. Correct? So therefore that. So if it's a non-resident, that 20% option with indexation will not apply to a non-resident.
When I sell the property, then the 20, like 1% for a resident person, 1% TDS is applicable. Correct?
Correct.
For non-resident person, 20% TDS is applicable.
Correct.
Correct. But now the flat rate of capital gain in itself is 12.5%.
So let him go. No, but so then he will have to go for a 195 to get a lower deduction certificate. Let him do his calculations. The problem is that how do you do his calculations also?
Like 100%, I'm talking about 100 property there, 100% gain is there. Then also it will be 12.5 only.
So it will be 12.5, it won't be 20% because 20%,
Now TDS is
12.5%. TDS will be 12.5 because 20% and with indexation option is not available to him. 195, the Finance Act does not give any rate of tax for capital gains. The Finance. Correct. So therefore TDS. Why 20%?
Now, 195 is applicable tax, now applicable tax is 12.5, then for English 12.5, we can move on.
Yeah, 12.5, why 20%? So if he, no, if he does not have a PAN, then your problem is right. But if he has a PAN, there's a problem. So what? Correct.
And 195, TDS tax of 90% consideration.
Where do you get that?
Why are you giving different from the Senate?
That is why he does not have a PAN. No? If he has a PAN, so where the rate of tax given in 195?
Tax on the total consideration.
But why it is 20? Okay, we'll examine. I don't think so. Okay, thanks. Chalo. Thank you so much.
That was an extremely interactive session, Yogesh bhai. Thank you so much. And I think that today's full house has really benefited from the detailed analysis of Yogesh bhai. To give a formal vote of thanks, I request Kailash ji.
Good morning, friend. I feel honored and privileged to get the opportunity to propose a vote of thanks to our eminent speaker, CA Yogesh Thar. Friends, CA Yogesh Thar enlightened every issue related to income tax with regard to individual, private companies, and NRI with various case law on income from rental income related to trust, buyback of shares, assessment under section 159, 168, etc. Friends, I feel our most of unresolved issue has been solved today. On behalf of JB Nagar CP Study Circle, I immensely thankful to CA Yogesh Thar to push this out to our sharing his knowledge and evidence of explanation of everything. I request you to give a round of applause for everything right?
20%
Yeah.